Investors terminology overview. Let's talk about a real world scenario that sets the scene. In the first place though, hi. If you work in finance, especially in FP&A, or maybe you don't, but work with people who do, or you're studying with the intentions to one day join the business world, one thing is almost very certain. You're going to come across a company that has been invested into. Maybe it's a startup backed by venture capitalists. Maybe it's a scale-up mid-market or mature business now managed under a private equity platform. And in those rooms or those calls, people start talking. They throw out acronyms like PE, VC, FD, GP, MOIC, like everyone understands what they mean. You sit there, you nod until someone breaks the silence and asks, what's PE? Then they say, pause, private equity, you're relieved you're not alone. And then from there, someone else asks, what's FD? Finance director. That's a new one for someone in the room. Then it hits home. We are all talking past each other. The room needs clarity. So what do? You postpone that particular meeting. You go away, get a list of real one, proper, comprehensive list that everyone can use, because sometimes the biggest barrier to understanding isn't the complexity, it's just the language. So together, let's walk through this. A good place to always start is to start at the very top. Let's begin from where clarity begins, the top. Before diving into investors' decks, financial models, or KPI dashboards, it's important to understand what your investors are, what they care about, and why their expectations shape everything you are being measured against. Because depending on whether your company is backed by venture capital on one side or private equity or both, the lens through which your success is evaluated can look completely different. So let's start with venture capital, what they do and what they want from you. Venture capital, VC for short, is designed for the early game. Think concept, stage, early traction, post-revenue, but pre-scale VCs, back potential. They bet on ideas, teams, and the promise of disruptive returns. Their investment strategy is rooted in the portfolio theory. They know that most of their best will not return capital, so the few that do must return exponentially, 10x, 20x, even 50s, which is why growth trumps everything, not profitability, not cash flow, not even operational excellence. In the VC world, the goal isn't the perfect machine. It's to find a signal that the machine can work, that you struck something big, that product market fit isn't just real but scalable. That therefore means you rewarded for expanding aggressively, not consolidating. You hire ahead of revenue, not behind it. You track metrics like MR growth, burn multiples, CAC payback, LTV, CAC, and runway. Profitability is a future milestone, not today's priority. Your job as a VC-backed company is to get big fast, to learn fast, to prove that your market is real and that you are the one to dominate it. Because in the venture world, being first doesn't guarantee anything, but being fast often does. Private equity, on the other hand, they play the mid to late game. They don't invest in dreams. They invest in systems, cash generating margin, expanding cost discipline systems. So with the PE firms, here's the drill. They often acquire majority or controlling stakes in established businesses. Capital structure is leveraged, meaning a significant portion of the acquisition is funded through debt, not equity. So guess what? Cash flow matters, and a lot. Their strategy revolves around a few core levers: operational improvement, margin expansion, pricing optimization, platform builds and roll-up, buy and build, working capital efficiency, bolt-on acquisitions, and ultimately exit multiple expansions. They measure your success in multiples of invested capital, MOIC, an internal rate of return, and the focus is almost always on EBITDA multiples. As a company in the hands of PE, you're expected to scale efficiently, not recklessly. Return on invested capital, ROIC, becomes the North Star. You adopt discipline over experimentation and execution over exploration. KPI dashboards will include EBITDA margin, debt service coverage ratio, free cash flow, revenue per head, and cash conversion cycles. So you have to understand that your job is therefore not to invent the next thing. It is to make the current thing run better than it ever has, and it has to do so at a pace and precision that allows the fund to realize its return, typically in the next 3 to 5 years. Now, how does this all connect to what we've already covered? So, before diving into the technicals of your model, the waterfall of your forecast, or the sensitivity of your scenario plan, let's start here. Know who's watching, know what success looks like through their lens. VCs will push you for growth. PE will press you for return, both one discipline but in different forms. And what fundamental understanding is that the top of the conversation sets the tone for everything else below it. The full terminology landscape. Let's go. Term sheet. This is a non-binding summary of the terms in which investors plan to invest. Due diligence. The investor's audit. It's a deep dive into the financial operations, legal exposure, and commercial risk. Valuation. The assigned worth of the company. Often a flashpoint in negotiations, calculated using method like DCF or comparables. Cap table. This is a spreadsheet that defines ownership, equity, options, converts. Exit strategy. How investors plan to see the return, IPO acquisitions or secondary sale. Waterfall distribution. Who gets paid in what order when an exit happens. Earn-out. A performance-based incentive paid to sellers post-acquisition. Seed funding. The early bet. Capital to build the product and test the market fit. Series A, B, C structured stages of funding as the company grows and proves scales. Convertible note, a debt that turns into equity at the next period round. Runway, how long the company can survive at current burn rate before it runs out of cash. Burn rate, the monthly net cash outflow, essential to understand urgency. Pre-money / post-money valuation, the company's worth before and after new money enters. Buyout, acquiring a controlling stake in the business. Leverage buyout, LBO for short, a buyout funded mostly by debt with the target cash flow expected to pay it off. Carried interest, the GP's share of fund profit, often around 20%. Limited partner, LP, the capital provider. General partner, GP, the fund manager and deal maker. Platform company, the initial acquisition from which the PE firm builds out the strategy. Add-on acquisitions, smaller target acquired and then bolted onto the platform. Roll-up strategy, aggregating companies in a fragmented market to drive scale and valuation. Now let's look at financial metrics and ratios. EBITDA, earnings before interest, tax, depreciation, amortization, a measure of operating profitability. Debt to equity ratio, a measure of leverage, indicates financial risk. IRR, annualized return over investment horizon. MOIC, total value returned as capital invested. Free cash flow, the holy grail, FCF for short. The true health indicator, cash after capex. Rule of 40, growth rate plus EBITDA margin is equal to or greater than 40%. You're healthy. In SaaS, at least. Now let's take a look at the governance and legal terms. You've got covenants. These are the conditions set by lenders or investors to manage risk. This can be financial as well as operational. Shareholders agreements, the rule book amongst the owners. Drag along rights, force minority to sell when majority does. Tag along rights, let minority follow majority in a sale. Anti-dilution provisions, protect early investors from future rounds that will or could lower their valuation. Board composition post-debt. The board is often restructured and reflect investors' oversight. Platform builds specific terms. Synergies, savings or revenue boost from acquisitions. Integration plan, blueprint for aligning systems, teams, and cultures. Bolt-on acquisition, smaller strategic fit added to the platform. Operational leverage, scaling operations without a linear cost increase. Now let's talk about some key performance indicators, KPIs for short, especially vital for SaaS or hybrid professional services model. ARR, MRR, subscription-based revenue measurement. Churn rate, NRR. Retention is growth in disguise. CAC, LTV, unit economic of growth, revenue and cost per employee, operational productivity indicators, clawback. LPs can reclaim excess carry if long-term fund performance underwhelms. Management fees, typically around 2% annually of assets under management. Capital call. The fund requests committed capital from LPs. Dilution. Ownership shrinkage due to the new share issues. Benchmarks. Performance milestones set by the fund or the board. So let's connect all this together. The biggest risk in a high-stakes financial room is not asking the question, but there is a reason people hesitate. The language of investment can be dense, acronym-laden, and exclusionary. But when you decode it, when you break it down, term by term, it stops being a foreign language and becomes a strategic tool, because every term is a lever, a decision, a trade-off. And whether you are a founder preparing for your next raise, newly hired FP&A analyst trying to get a handle on the model, or the CFO navigating a private equity board, or for the first time, these aren't just words. They are how money moves around. They are how growth is understood. They are how trust is built. By way of introduction, I'm Hamilton Alogaga, an ACCA qualified accountant with decades of experience in financial performance management reporting, offering FP&A as a service. I have spent years building models that don't just forecast, they explain, that don't just report, they lead. My approach connects the operational to the strategic, using the same terminology we just covered, but putting it to work in model, forecast, board packs, and transformational strategies, and make these terms matter. If your team is navigating a capital raise and board presentation, or just trying to get alignment of KPIs, let's talk. I offer bespoke driver-based FP&A services that translate business drivers into strategic financial clarity. Whether on a project base or short-term contract or retained engagement, let's build something exceptional together. But for now, thanks for watching, and until the very next time, happy financial planning and analyzing, and stay confident.